All right. Thanks for having us.
So we'll talk a little bit about venture capital. So I've made 150 investments and started about 40 companies, have 3 venture studios, offices in Singapore, Zurich, and here. And all software and all pre-seed, seed, and Series A. So a very specific investment thesis as a VC. Now, if you read LinkedIn much, there's a lot of what I call VC hate. You know, here's the dirtiest secret about VCs, or here's this about VCs, and it's always by non-VCs, right? And I understand why. I mean, I've been a venture-backed entrepreneur. I've raised capital many, many times for ventures. I currently have 16 startups that I've started. And so I get it. I've been on both sides, right? But right now, let me describe a couple of things. There's a couple of comments that were made by the earlier speakers, which is kind of fun. One was about, becoming a professional football player. It's actually easier to become there's about 1 million high school football athletes in the U.S. 1 in 588 make it into the NFL.
Oh, it's not so bad.
5.5 million new starts every year in the U.S. I'm not sure how many in India, but take that times about 100 probably, right? But 5.5 million startups and only several thousand get venture capital. So 1 in 1,375 try to get venture funding, that pitch actually get venture funding. What that means is your likelihood of becoming a professional football player is 2.3 times higher than getting venture capital. So because of that, oftentimes you get entrepreneurs very frustrated, So I personally get about 1,000 pitches a month. Our fund website gets about another 1,000 pitches per month. My partners, including Tim Tebow and others, get 500 to 1,000 pitches per month. So that's a lot of pitches. And then you'll see stats like, well, the VCs will never look at your pitch deck. They spend exactly 20 seconds on it. Well, I don't read pitch decks. What I always do is refer them to, we have a submit your startup for funding link. And then we use a series of Q&A to walk them through that, right? I get a lot of pitches that if I were to look at them are completely a non-fit, right? It's just like, hey, I invest in very specific things. So I know you haven't read my website because you're sending me medical products. I don't do medical products, but so please go to my website. And then we work through that. We do a lot of automatic diligence. So one of the things I want to talk about is VC in general and what the trends have been. VC follows along with economic cycles. So in a high interest rate environment, capital flows to debt rather than equity with an eye on liquidity, right? If I sat there and said, I'm going to tie up your money for about 10 to 12 years in my VC fund, and I'm hoping to return a little bit more than public equities, right? Maybe 15 to 20%. Or you can say, I can make about 5%, maybe more, highly liquid in high yield lending or high yield debt markets. Guess what? So capital ebbs and flows in and out of VC along with interest rates. And we've been through some really interesting periods. So right now, VC overall globally is way down compared to post-COVID VC. Why? Post-COVID interest rates were zero. Capital was plentiful. Money was thrown at startups, right? So right now, if you're pitching, how many people right now are pitching for funding? Do I have anybody? Yeah, if you're pitching right now, your chances of getting venture capital right now compared to 3.5, 4 years ago is really, really low. It's painfully hard. And I am an entrepreneur. I understand the pain of that. But I would just say we're just in a down cycle. Now, there's signs of revival, right? So again, in tight interest rates environments, when interest rates are high, IPOs tend to dry up. Private equity tends to dry up, right? Because interest is high. You don't have as much debt leverage to put on stuff, et cetera. So VC startup investing has everything to do with the expectation of liquidity, exits, IPOs, being acquired by a PE firm, et cetera. So right now it's a bit of a low period, but there's signs of recovery, right? Interest rates are starting to come down, favorable legislation. And so I would say hang in there, there's hope. Money will flow back into venture capital as interest rates come down. Venture capital right now sits on capital. We have capital reserved in funds to bet on our winners, those that we've already invested in that surge ahead, get more capital, right? So there's a lot of dry powder, but hang in there if you're trying to seek funding. But overall, venture capital is shifting around. It ebbs and flows. In terms of different geographies, valuations in the U.S. are way high and inflated around AI. Really frothy right now around AI. It's like this reminds me of .com days. So I lived through that. I was an entrepreneur, had a whole bunch of .coms that I started. And in those days, if you slash a .com onto your name, splash it on there, attach it, staple it on there you go. Oh, wow, now you're worth 10 times more. It kind of feels that way right now with AI. Call yourself AI. Say we're an AI-enabled something, and boom, valuation, right? But in general, venture capital is alive and well. There are some model changes. How many of you know what a venture studio is? A couple of you? Yeah, it's kind of a combination of a founding team, plus an incubator, plus an accelerator, plus a venture fund, all in one. So I have 3 venture studios, Singapore and here in Dallas and one in Fort Worth, and doing different things. So don't worry about the fact that they're only 30 miles apart. But so a venture studio basically removes all of the conflict, all of the tension, all of that friction cost between those various parties. So in the venture studio in Fort Worth, and I'm a co-founder of all 3 of those, but the one in Fort Worth where I hang out for most of the time, all of those startups are my ideas. So it's kind of like, and I have a fabulous team that works with me in the course, contribute to those ideas. I shouldn't say my ideas, with the team's ideas, if you will. But I'm the primary visionary and strategy guy. And then we have a chief, design officer, chief product officer, chief technology officer, etc. And we have capital. So we're just take an idea, run hard, run fast, boom. So that's a wave of innovation coming to venture capital. I happen to think it's the most efficient way to deploy capital, because you're moving through ideation, validation, creation, and launch very, very quickly with very little resistance, and the willingness to shut it down if it doesn't work. If it doesn't pass from the ideation phase to validation phase, forget it, stop funding it. But you're not wasting any time raising capital and not wasting any time trying to figure out who to hire. I'm fond of saying that 50% of a founder's time is wasted on raising capital, and 50% of that capital that you've painfully raised is wasted on non-strategic stuff. Who should I hire? Do you recommend a lawyer? Do you recommend a tech guy? I've got an idea. Who should I hire? Should I lease an office or go co-working? We skip all of that with a venture studio. So in terms of big themes, venture studios outperform venture funds by 2.5x. 20-year study, 600 venture studios globally, including in India, outperformed the average venture capital returns by 2.5x over a 20-year period of time. Now that should get your attention in terms of what's happening in venture capital and what's next, right? So just stay in tune for the term venture studio. And again, there's one right here in Dallas, 1845 Venture Studio. Mine is called Eagle Venture Studio in Fort Worth. We have Eagle Venture Studio Singapore. Okay, so what I want to introduce, or you've been introduced, but I want to turn to Samantha for a moment with Silicon Valley Bank, where if you're not dialed into this, has been kind of the most founder-friendly entrepreneur startup venture bank for decades. One of my startups 20 some years ago, Silicon Valley Bank was the obvious choice for me as a bank. And you lead a lot of Texas, Oklahoma, Arkansas, half the world. And you've been doing this for a while. So, in terms of a venture bank, what's your perspective on venture capital, startups, innovation, et cetera?
Oh, that's such a good question, and I'm glad you asked that, because SVB's been doing this for 40 years, and I've seen thousands of companies come through our door just within the Dallas market alone and some of the surrounding areas. And there's a couple of trends that you touched on that I think are impacting the venture landscape. One is AI. It's ubiquitous, it's everywhere, it's the latest buzzword. And I think when you look at the statistics that are out there right now, it says that this is the second biggest year of venture capital dollar deployment on record after 2021. But when you kind of peel that back and say, well, what does that mean? It's actually masked by what's going on in AI. 70% of those dollars have gone to deals that are valued at $100 million or more. So, or 100 million round sizes or more. So these are large rounds that are sucking up most of this capital. It doesn't leave a lot left for the entrepreneur, to Wade's point, that's going out and raising that early round, especially here in Texas where our round sizes don't tend to be that large. In fact, the top 5 AI companies today, combined valuations are more than all the .com exits put together. So if you kind of put that in mind, you've got this backdrop of AI and its disruption, but it's also disrupting and skewing the venture landscape. And I think what that's doing for startups in particular is it's making things like venture debt much more important for their capital stack as they're considering, how do I fund my business? It's very important to think about that when the graduation rate, for example, from seed to Series A is way down. Only 5% of companies raise a Series A in 18 months. That's down from almost 20% 4 years ago. And the time that it's taking to go from, let's say, Series A to a Series B has also lengthened. So thinking strategically about how you're going to fund your business has never been more important. And venture debt that banks like SVB offer are very important to thinking about, how do I do that in a non-dilutive way? And how do I make sure I don't run out of money before I hit the next critical inflection point to keep my business going and return value to my investors? One of the things I wanted to tie Pialy into it is some of the trends that we're seeing. So macroeconomic trends, but also geopolitical trends. Right now, hardware and robotics is having a moment because defense tech is hot. Everybody's looking at dual use, and defense has got a lot of attention on it. And that's been driven by a large part by the current administration and some of the things that are going on. On the flip side, a lot of these robotics companies and hardware companies have parts they have to procure, and so they're getting a little bit dinged there by the tariffs. And then if you contrast that, crypto, which was the buzzword of like pre-COVID times, everybody was Web3 and crypto, and that had its moment too. That's coming back, and that's really coming back because of things like the Genius Act, which have really shined a spotlight on digital currencies and really given them some credibility and viability that are now making them more mainstream, which I know is an area you focus on.
Yeah, it's huge for us, and I think you're right. At Republic we started in 2016, but we started with crypto in 2017. We did the first compliant token sale to the U.S. non-accredited investor. So we've seen like the crypto winters, and the Genius Act has been quite helpful. It's really given this like headwind and this tailwind, I should say, and just infused a lot of oxygen back into the industry. We've had already, I think, 2025 about 15 billion in investments in blockchain-based companies, and these things are really, really important. There's now a lot more regulatory clarity. What's a security, what's a commodity, what's crypto, and there's a lot of innovation kind of incentives. There's a lot of investment happening, and you'll see that's kind of fueling the acceleration of digital assets and digital finance and decentralized finance. Those are going to be kind of the building blocks, I believe, and not just me, I mean all the institutions now are talking about it, the building blocks for kind of the future of US finance, our financial system.
So Pialy, I would love for you to explain more what Republic does, because I think it's fascinating, and especially as a VC where I've got angel investments that are 28 years old. Where every once in a while I'll ping the founder and go,
are you still alive?
Is there going to be an exit? Yeah. It's about tax time every year, and the CPA goes, are you going to get a K1 from that company this year? But I would love to explore, how do you do secondaries? How do you help do that?
Well, we can help you with your secondaries.
Go with this.
Yeah.
Tell us more.
I mean, we do, it's so hard to explain now what Republic does, but as I mentioned, we started in 2016, really on the heels of the Jobs Act. So Title III legislation of the Jobs Act allowed for the first time the non-accredited investor to take part in early stage capital formation. So that's where we started, quickly got into crypto, and then we actually also started SPVs into late-stage pre-IPO growth companies. So we do primaries in SpaceX, Carta, Klarna, Robinhood, a number of companies. And then we decided to be an RIA, so we have several of our own funds. The funds tend to have various theses like deep tech space, fintech, Web3. We're about to close a fund with Temasek, the Sovereign Wealth Fund of Singapore. They had their own fund, but I guess they realized like our strengths in the Web3 space, so they're anchoring it with 50 million. We'll grow probably a $200 million fund, stage agnostic. But now we're just kind of almost the good housekeeping seal of approval in crypto because we do it so compliantly. We use old like 1930s law. We've expanded into Europe, so now we can issue securities in the US, UK, all 27 member states of the EU. We have members we have investors in over 100 countries. And we do everything from white paper, we do the tokenomics, we do tokenization. We have a retail platform that allows for trading of both equity and crypto. Secondaries we're launching soon. We already have secondaries in the UK, but we have an ATS license in the US that allows us to trade public equities as well as secondaries. So we'll have that in crypto and in equity. We do a lot of treasury management, so yield staking, and crypto is one main focus. But we're heavily in equity as well and helping early stage companies raise capital from non-accredited investors as well.
So if there's early stage founders here in the room, they could potentially come to Republic.
Just like you said, don't come to me, apply on the website. And we have a whole, there's a lot of platforms out there that help entrepreneurs. We're one of them. We tend not to do pre-revenue, so we like to see product market fit, but you can apply on the website and the team will get back to you fairly quickly.
Yeah, Samantha?
I wanted to pick up on something Pialy just said about secondaries. This is such a trend right now. Venture funds used to be a 10-year cycle, and now with things staying private longer, LPs are saying, where is my return? And that fund cycle stretching out to 15 plus years now. So we've seen a significant increase in secondaries, which for those that aren't familiar with that is, it's the ability for private stock to become liquid. So there's a lot of investors now that are out there that are buying stock from private owners at SpaceX, for example, so that those early stage founders or the early stage VCs that participated in those can start to get some liquidity back that they can recycle then and deploy elsewhere. So there's a big trend right now in secondaries and liquidity.
It's interesting because I also on the side, I have a side hustle. It's called the Walkstar Fund. We're a venture fund that invests in female founders in tech. We have great LPs, JP Morgan, Bank of America, all investors in our fund. And I just am we have a little left in the fund. The fund started in 2020. And I was talking to a founder and I literally said to them, I'm not holding this. I'm a huge supporter, but I'm not holding this for 10 years. So your next round of funding, I want like a chance to get out at that funding. And I'm telling them now because I'm not holding a 10-year fund. I'm more than a 10-year fund, and maybe a 12, okay? But no longer than that. I'm not doing a 28-year exit at all, Wade.
As is an angel when I don't have any say in the matter, right? So Samantha, does SVB help with secondaries at all?
We don't really participate in that so much, but we see a lot of them. And there's a new, there's a group that the bank partners with to help facilitate some of those private stock exchanges. So we have an affiliate that does that, but it's something that's just going gangbusters right now. Yeah. And it's just this hunger for liquidity. The other thing I was thinking, I'm curious if you're seeing this, is the traditional funds like if you think about the Sequoias and the Excels, all the name brand VCs, they've gotten so big now. They've got billions of dollars under management. They have to write these huge checks. They're also shifting to an RIA model. Yeah. And so venture's going through this growth spurt right now, and it's really changing how founders approach them and what kind of capital is available.
Yeah, let me address that a little bit. So if you're not familiar with that, venture cycles are becoming longer and longer because, again, when the IPO market's dried up, when interest rates are high and capital's constrained, you don't have the exit. So you have these hold times where most venture funds, we say, when I'm pitching LP investors, the limited partner investors in a fund, you kind of go, ideally, it's kind of 5 to 7 years. It's really been kind of 10 or 12. And so the RIA shift helps a lot of the big funds that have done that. So as a venture fund grows up, you tend to write bigger and bigger checks at later and later stages. You just do, right? Because your partner time is limited. I'm on 16 boards. It would be hard for me to take on another 10 boards, right? My time is limited. I'd rather be on fewer boards where I've written a much bigger check and the upside's gonna be much bigger, right? So if you're a founder seeking pre-seed funding, your best bet is a new small venture fund that is eager to make investments, that just raised a fund, and has plenty sitting on all that capital and has to deploy it, right? If you go to one of the big mega funds, oftentimes they'll say our minimum check size is 5 million or 10 million or 25, or we jump in at the A or the B, Series B round, et cetera. So if you don't know all these terms, you should educate yourself on that. But there's a lot of trends in venture capital. Back to the venture studio model. If you have a great idea, there are lots of co-founder venture studios. Like 1845 Venture Studios right here in Dallas is a co-founder venture studio. You come to them with their idea, they launch with you. They fund, they help you, they have all the experience to wrap around you. In Fort Worth, it's a founder venture studio. The ideas come from us, our own team. We're not looking for people to come to us with their ideas, right? We've got a long list. I've got about 100 on my list. So pick out the right partner. So an early stage fund, that's a small fund that's making investments in your range, co-found with like an 1845, do those kinds of things and just be aware of the dynamics in the industry. What the RIA status does for like a Sequoia or Lightspeed or whoever, it allows them to hold on to later stages, hold on longer, do secondaries, hold IPOs, hold public equities, kind of just a little bit of everything. Oh, we're just gonna manage your money, because they're really more of a money manager than they are willing to roll up their sleeves and work with startups, right? Which is painfully hard. Everyone starts there, but as you grow up, you tend to mature. Does that make sense? It kind of makes sense, right? So back to the panel here, and just kind of questions on general questions like how much time do we have? Okay, great. I think we'll go to some audience questions, and I've got a couple questions for each of the panelists. So how about any questions from the audience? Just shout it out and we'll try to take it on. Yes, sir.
Republic, basically one of the things you offer is sort of crowdfunding.
Yeah, equity and crypto crowdfunding.
Right. So what it seemed to me is that a lot of times you can get lost in the crowd.
Yeah.
In those environments, is there any assistance that Republic provides to get the word out about your startup?
You mean, so if you were a startup that was raising on the Republic platform?
Yeah.
Yeah, we have probably 4 million investors now on the platform, so we leverage our investors. They're probably the number one, and I think number two would be your community, because retail investors, what I've seen that does well on Republic are that companies that come in with a community themselves, and people who are really passionate about their investing. Like, we do have a number of investors and globally, so depending on where your top co is, you might raise with the US, you might raise with another subsidiary, and you might be able to also get international investors too. So if you're doing a Reg CF, you can raise up to 5 million in the US with the US top co. You could do a Reg A or Reg A plus and raise 75 million. There's a little more back and forth with the SEC. It depends on what it is that you're looking to do. But if you're also looking to get international investors, you do a Reg S. And as I mentioned, we have investors in over 100 countries now. So it really depends on what type, and there's Reg D that's accredited only. So it really depends on the type of investment that you want, the type of investor you want. And for them, their appetite for risk, their time horizon for returns, and what they're passionate about. Legally, every startup, this is legal for any kind of platform in the US. You have to be live for 21 days. So that's it. That's the minimum that you have to be live on the platform. I think our averages are probably 60 days now, maybe a little longer depending on the company, but 21 days, even if you have a campaign that reaches the 5 million, we'll have a wait list. So you'll get the 5 billion, there'll be a wait list, and then I think, at some point everything's held in escrow and you'll be able to take out like a huge chunk towards the end of the campaign.
Other questions from the audience? Yes, ma'am.
As a VC, how do you identify if a macro trend is real and is going to last, or how do you identify risks there?
I'm sorry.
So say, for example, AI, or with the onset of AI and there is a hype, so as a VC, how do we identify if these macro trends are like temporary or will last how do you make those decisions?
Oh yeah, so there are a lot of trends. Like right now, I would not invest in an AI wrapper application that just sits on top of OpenAI or Anthropic, for example, because their next feature is going to eliminate 1,000 AI wrappers, right? So AI is here to stay. So it's not a fad, but what's kind of faddish are all the little wrappers. That just, unless you have a lot of proprietary data or really deep analytics or something that's really quite unique proprietary, so even though AI is here to stay, there's a lot of little faddish things going on in AI. And right now, kind of, we're seeing that, we're in that hype wave. If you're familiar with Gartner Group hype wave, right? There's a lot of hype around AI, but basically all we have is a bunch of cats riding bicycles or baby Trump videos arguing with baby Zelensky videos. But it's kind of an interesting stage. But I mean, AI is definitely here to stay. So yeah, in terms of parsing it out though, my main thesis is my venture firm is all impact oriented. So we only invest in impact opportunities. And so very specific impacts, like 2 of our funds only invest in tech companies combating human trafficking. So I just want to set people free, whether it's sex trafficking, labor trafficking, or keeping children safe online. And so that's very, very specific, and there's no fad that'll change that, right? Type thing. So I mean, I don't try to sort through that. The biggest thing we do, and I think this is a question for the other panelists as well, is really sort through the founders. And I really, I spent a lot of time trying to, creating scores for founders. What I don't want to do is read a long form bio or sort through a LinkedIn page and try to figure out, is this a founder I want to invest in? So what I've done is all kinds of scoring, like yes/no questions that a founder can answer for me, and then from that I'm discerning if they have the right characteristics as a founder. I'll tell one story in myself. So I love founders. I literally want to invest in every single founder that pitches me. So I you know what I mean? It's just like I love the enthusiasm, the idea. This is great, And of course, it's like if you spend a lot of time in China and everything's hi, and then, which also means yes. It also just means I understand. And then you go, so good, we got a deal. No. and I don't want to do that to a founder, right? So it's like, okay, I got to put up some guardrails. And so I want to make sure, because here's one thing I did. So I went back, and so my angel investments alone have been about 100 angel investments, right? And in addition to all the fund investments, but as an angel, it's like, that's when I make my biggest mistakes, or over coffee, they're pitching, And I realized that my biggest failures were I invested in a founder that had no leadership experience, that never led anything, right? And so you kind of go, okay, how was I expecting them to lead in a low resource, high stress environment if they'd never led anything before in their life? It's like I'm a former Army Ranger, and I'm a combat vet. I would never send someone into combat to lead a company of infantry if they've never been taught all the leadership lessons. And you would never send a private into combat if they haven't been at least to boot camp, right? And so one of my biggest screens for founders is, tell me all about your leadership experience. And just a bunch of yes/no questions, right? Like, over their life, have they always kind of taken charge of the room? Have they been in charge? Were you in charge of this and that? High school, college, throughout. Did you have a whole bunch of leadership positions? And so for years, I never even thought about that. I sort of assumed, because I'd had all those leadership experiences, that they probably did too. And if they were really good at pitching, you just sort of assume everything else about them. This is great. You're gonna do really well. And so what I want to ask Samantha next, and then I'll come over to you, is what kind of traits do you look for in founders, and what's really critical for you?
Oh, there you go. That's a great question. So I typically see 2 baskets of founders. One are the ones that are startups and they haven't raised their institutional round yet. They're pre-VC. And the others have raised VC and they have a loan with us. And so I think if I'm kind of trying to align the baskets, the ones that have a loan with us are the ones that have gone to folks like Wade, or I see Mike in the audience from Live Oak. Those founders have one thing in common when they're successful, and it's persistence. They are really good about just breaking through the things that are tough, breaking down the problem. I think some of the gentlemen earlier spoke about this. They're determined. They will tackle the problem one bite at a time. They will be able to inspire their team to follow them and execute through that strategy. And they're relentless in a great way. And I think the ones that succeed have that grit and determination. The ones that I see that have failed, it can be a number of factors, but all of the founders, whether they succeed or fail, that I find intriguing and interesting have that persistence.
Very good.
I guess I'll talk from a Walkstar perspective. As I mentioned, we do seed in Series A, so there's already product market fit and revenue. So it's not super early, but I really like to see founders who bring in their ecosystem. We at Republic do it a lot as a early stage company. Well, I guess we're not early stage now, but when we were, we had a whole ecosystem. We spun out of AngelList, and one of our founders created CoinList, and so we had this really cool ecosystem that we started diving into, and then we had relationships with all of the top VCs and banks and consulting firms, and we got to figure out, we were able to convince institutions to invest. So I look at founders who maybe they don't have the ecosystem to start with, but they're able to get into those ecosystems, and I feel like that's how you grow.
That's really good. One of the good pieces of advice that I've heard recently is build your community first and then build your product. Because if you're not a subject matter expert at your end customer, and so I judged a pitch competition down at Texas A&M, oops, different institution, and it was really fun because there was a young one, they're all college students, so this is really fun too, the energy, right, and all the ideas, amazing ideas, because they were the first generation to grow up with tech, at 5 years, your smartphone, honey. And so there was a girl there, she's only a sophomore at GW, George Washington University in DC, but she has 2 million followers on social media. She's done a Netflix special on beauty and fashion. And so it's does she have community? Absolutely. So she was there pitching, her thing was, I know my audience, and it's all these, girls my age or a little bit younger, and she's doing, and it was an AI pitch competition. So she had developed on her own, and she, as an engineer, right, she developed an AI app, like an AI sort of makeup chatbot. And so she could serve millions of people simultaneously with an AI app that would sort of analyze, send me up your photo, I'll analyze you, I'll give you your color palette, and I'll do all this, I'll do all that. And I'm like, oh, holy cow, there you go. She had her community, she already had a following, and now she's rolling out this app for recurring revenue. Bing, so she was one of the ones that took away a check, right? So that's really cool, isn't it?
Great at Republic, because she has retail investors love that. They like to invest in what they're passionate about, and storytelling is really important for retail investors. So if you get a retail investor in something like that, someone who's using her product, they're going to buy the product. They're going to tell their friends. They're going to buy it for friends. They're going to post it on their own social media saying that they're an investor in this company, that they use this product, and then you get an army of evangelists. Yeah. And that you can't get from just the ultra wealthy investor.
Yeah. Okay. Final quick comments. Couple minutes from each of us on just takeaways.
Let's
I would say not all hope is lost. It is a tough venture ecosystem, but there is a lot of stuff happening at that seed stage, because that's where investors can get value right now. If everything's overvalued and they've got to write big checks and they've got to be super competitive at those later stages, a lot of people now that have those funds that are early stage focused, a lot of the regional firms that spend time in Dallas, for example, they're focused earlier. So, seed investing has boomed. And I think that should be encouraging to all the founders in the room that are building something, is if you're at that early stage, there are still people that will invest in you. There are still funds that are hungry, but just know the bar for that next level has moved up. So if you can kind of just know what your product is and where that next inflection point is, in SaaS, for example, a Series A is probably 3 to 5 million of revenue. Don't let that be discouraging. Aim hard for that, and just know that there are definitely investors that will support you if you can hit the metrics that you need to.
Yeah, I think that's important. We're seeing interest rates go down, and then we'll see more. The IPO markets are coming back, We'll see.
We hope so.
Yes. And so we're going to see more liquidity, but capital will hopefully be cheaper. There'll be more access to capital. People will be higher returns and go into private markets as an asset class. So I think like the good times are going to come back. Unfortunately, if you're not in AI, it might be tough to raise. But if you're here in Dallas, focus on the areas that are of interest in Dallas. Semiconductors, huge here, a lot of tech manufacturing. There's a lot of kind of climate tech happening, clean energy, think solar, wind, all happening here in Texas. So if you kind of play to what's strategic, the macroeconomic trends for sure, but what's strategic to Texas, I think that's important. And then you're here at SMU, so being able to connect to universities and schools, Texas A&M, UT Austin as well, just to like build out your credibility, get access to some of that like real cutting edge research, and then get them to be your pilot. That's what I would do if I was a founder here. I think that it's going to get better than where it's been.
One final thought on really early stage is there's about a dozen angel investment networks in Dallas-Fort Worth, about a dozen. And so there's lots of ways to dial into that. 1845 Ventures just posted on LinkedIn a link to all of them. And go to the venture studios like 1845 or Eagle Venture Studio, if you will. We do some, we'll entertain some ideas from outside. But there's other venture studios and incubators and accelerators. There's Startup Grind, so there's startup ecosystems. I went to Startup Grind a couple times, 500 entrepreneurs in a room, lone VC, got chased around the room. But no, there's community out there. There's a lot of big communities around Dallas-Fort Worth. There's Techstars, there's incubators, there's accelerators, et cetera. So please avail yourself to all those kinds of things. Pro-forma.com is a website if you're a founder you definitely want to check out. It's proforma.com. There's a dash in there. And it has all kinds of tools, absolutely free to founders. And so we just completed a financing on proforma.com with 58 angel investors, a $5 million financing at a $100 million valuation. So initial financing for a company, 58 angels, all on Proforma. So there's stuff that you can do, places you can go. But this has been wonderful. Thank you very much for your rapt attention.